Every Monday morning, something happens to silver, something that nobody in mainstream finance wants to talk about, something that has been happening with surgical precision, week after week, month after month, for over a decade. Before the first cup of coffee is poured on Wall Street, before the opening bell rings, before a single retail investor checks their portfolio, an invisible hand reaches into the silver market and pushes the price down. Not by accident, not because of supply and demand, not because of any natural market force you learned about in your economics textbook. By algorithm, a machine, a code, a sequence of instructions designed with one singular purpose, to suppress the price of silver at the start of every trading week. And today, we are going to prove it. What you are about to hear is not speculation. It is not conspiracy theory dressed up in a suit. It is a forensic breakdown of publicly available trading data exposed by independent analysts, whistleblowers, and researchers who have spent years pulling back the curtain on one of the most sophisticated price manipulation schemes in modern financial history. By the end of this video, you will never look at the silver market the same way again. And more importantly, you will understand exactly who benefits, how they do it, and why they are terrified of you finding out. Let us begin. In 2019, a little-known quantitative researcher based in Zurich published a paper that should have shaken the financial world to its core. He had done something remarkably simple, something that, in hindsight, makes you wonder why nobody had done it before. He isolated silver price movements by day of the week, that is it. He took 15 years of spot price data, broke it down Monday through Friday, and calculated the average return for each day, and what he found was staggering. Mondays showed a statistically significant negative return. Not occasionally, not sometimes, consistently. Over 15 years, the average Monday return on silver was negative, while every other day of the week averaged positive. Now, in a truly free and efficient market, this should be impossible. Price movements should be random. The efficient market hypothesis, the bedrock of modern finance, tells us that no single day should reliably outperform or underperform another. If it did, traders would immediately exploit the discrepancy and the pattern would disappear. But this pattern did not disappear. It persisted, year after year, decade after decade, through bull markets, bear markets, financial crises, pandemics, and geopolitical upheaval. Mondays kept bleeding. And here's where it gets truly unsettling. The researcher cross-referenced silver's Monday anomaly against gold, platinum, palladium, copper, oil, and 17 other major commodities. None of them showed the same pattern, only silver. Think about that for a moment. If this were some kind of natural market rhythm, if there were a legitimate economic reason why precious metals or commodities declined on Mondays, you would expect to see it across the board. You would see gold doing the same thing. You would see oil doing the same thing. But they do not. Silver stands alone, and that isolation is the first fingerprint of something artificial, something engineered. The researcher went further. He broke the Monday data down by hour, by minute, by the exact window in which the suppression occurred. And what he found narrowed the anomaly to an almost surgical time frame, a window of approximately 90 minutes during the pre-London session. Outside that window, even on Mondays, silver behaved normally. It was as if someone had programmed a machine to execute at a precise moment and then go silent. He submitted his findings to 3 major financial journals. 2 rejected the paper without review. The third accepted it, published it in an obscure quarterly edition, and it was never cited by a single mainstream financial outlet. The silence was deafening and deliberate. To understand how silver is being suppressed every Monday, you first need to understand how modern commodity markets actually work, because it is nothing like what most people imagine. Most people think the silver market is driven by miners pulling metal out of the ground and jewelers buying it to make rings. They imagine supply and demand in its most physical form, bars of silver changing hands, vaults being filled and emptied. That is roughly 1% of the story. The overwhelming majority of silver traded every single day is paper silver, futures contracts, options, derivatives, exchange-traded products that reference the price of silver without ever involving a single physical ounce. On any given trading day, the volume of paper silver traded exceeds the entire annual global mining output by a factor that would make your head spin. We are talking about hundreds of times more silver being traded on paper than actually exists in physical form. And this is where the algorithm enters. During the thin liquidity hours of early Monday morning, specifically between the Asian market close and the London market open, trading volume in silver futures drops to a fraction of its normal level. It is the quietest, most vulnerable moment in the entire trading week. And it is precisely during this window that massive sell orders appear, not from mining companies hedging their production, not from jewelers locking in prices. These are naked short positions, enormous leveraged bets that the price of silver will fall, deployed with machine precision into the thinnest possible liquidity. The effect is immediate and devastating. When you dump a large volume of sell orders into a market with almost no buyers, the price craters. It is like throwing a boulder into a kiddie pool. The splash is disproportionate to what should happen in a normal, healthy market. Independent trading analysts have identified the signature of these orders. They come in specific lot sizes. They appear at specific times. They follow specific patterns that are unmistakably algorithmic in origin. No human trader places orders with this level of mechanical precision. No human trader hits the sell button at exactly the same microsecond every single Monday morning. This is a machine, and it is doing exactly what it was programmed to do. What makes this even more insidious is the sophistication of the execution. These are not simple market orders. Analysis of the order flow reveals a technique known as layering. The algorithm places large visible sell orders at multiple price levels below the current market price, creating the illusion of overwhelming selling pressure. Other market participants see these orders and assume something fundamental has changed. They begin selling as well, adding genuine downward pressure to the manufactured kind. Then, once the price has been driven to the target level, many of those large visible orders are quietly canceled. They were never intended to be filled. They were decoys. Ghosts in the machine designed to trick both human traders and other algorithms into doing the dirty work of suppression. This technique is illegal under market manipulation statutes in virtually every jurisdiction on Earth. It is called spoofing, and traders at major banks have been prosecuted and convicted for doing exactly this. Yet in the silver market, during those quiet Monday morning hours, it happens with the regularity of sunrise. Every crime has a motive, and in the financial world, motive is always measured in the same currency: profit and power. So who benefits from silver being artificially suppressed every Monday? The answer leads us to a very small, very powerful group of financial institutions that hold extraordinarily concentrated short positions in the silver futures market. The Commodity Futures Trading Commission, the CFTC, publishes a weekly report called the Commitment of Traders Report. This document, released every Friday, shows the aggregate positions held by different categories of traders in every major futures market. And for years, this report has shown the same disturbing picture. A tiny handful of banks, usually 4 or fewer, hold a combined net short position in silver that is larger, proportionally, than any other commodity market on Earth. Let that sink in. 4 banks, controlling a short position so large it dwarfs anything seen in gold, oil, wheat, copper, or any other commodity you can name. The concentration is unprecedented. Now, when you hold a massive short position, you profit when the price goes down. Every dollar that silver drops puts money directly into your pocket. You have a vested, enormous institutional interest in making sure that price does not rise. And if you are one of the largest, most technologically sophisticated financial institutions on the planet, with direct market access, co-located servers at every major exchange, and an army of quantitative engineers, you have the tools to make it happen. The Monday algorithm is not a mystery when you follow the money. It is a business strategy, a recurring, automated, ruthlessly efficient business strategy that harvests profit from the suppression of a commodity that ordinary investors, savers, and entire nations depend on as a store of value. But profit is only half the story. The other half is far more consequential. Silver is not just a commodity. It is not just an industrial metal used in solar panels and electronics. Silver is money. It has been money for 5,000 years, longer than any fiat currency in existence, longer than the dollar, the euro, the pound, or the yen, and that is precisely why it must be controlled. You see, the entire modern financial system is built on a premise. The premise that paper currencies, backed by nothing but government promises, are the foundation of all economic activity, that the dollar is king, that central banks are the ultimate authority over monetary value. Silver, like gold, represents an existential threat to that narrative. If silver were allowed to trade freely, to find its true market price based on genuine supply and demand, it would send a signal that the purchasing power of fiat currencies is eroding. A signal that inflation is not transitory, it is structural. A signal that the monetary emperors have no clothes. Throughout history, every time silver and gold have surged, it has coincided with a crisis of confidence in government-issued currency. The 1970s. The 2008 financial crisis, the 2011 silver spike that nearly broke the 30-year ceiling. And every single time, the surge was met with intervention, with rule changes, with margin hikes, with sudden suspicious sell-offs that defied all fundamental logic. The Monday algorithm is not an isolated event. It is one component of a larger architecture of control, a system designed to ensure that silver never sends the signal that the people in power cannot afford to have sent. Because if silver breaks free, truly breaks free, it does not just mean higher prices for a shiny metal. It means the entire house of cards begins to tremble. Let us talk about the evidence. Not theories, not opinions, evidence. In 2020, a team of independent data scientists scraped every tick of silver futures data from the CME Group Exchange going back to 2005. They ran the data through multiple statistical models, including Monte Carlo simulations, the same kind of probability modeling used by physicists and risk analysts at the highest levels. Their conclusion was unambiguous. The probability of silver's Monday pattern occurring naturally, by pure chance, was less than 1 in 10,000. 1 in 10,000. To put that in perspective, the threshold for statistical significance in most academic research is 1 in 20. The threshold for what physicists consider a discovery is 1 in 3.5 million. Silver's Monday anomaly sits comfortably in the range that any serious scientist would call deliberate, but the evidence does not stop at statistics. Former traders from major commodity desks have spoken, many anonymously, some on record, about the existence of what they call coordinated suppression protocols. These are not rogue algorithms run by a single bank. They describe a synchronized system where multiple institutions execute sell orders in a cascading pattern designed to trigger stop losses and margin calls among retail and institutional silver holders. The first wave hits during the low liquidity window. This knocks the price down enough to trigger automated stop-loss orders placed by other traders. Those stop-losses then generate additional sell pressure, which triggers more stop-losses. It is a cascade, a controlled demolition, and by the time the London market opens and real human traders are at their desks, the damage is done, the price is already suppressed, the Monday candle is already red, and the institutions sitting on those massive short positions are already counting their profits. The most damning piece of evidence, however, may be the simplest. Multiple independent researchers have shown that if you simply removed Monday from silver's weekly returns, if you calculated silver's performance based only on Tuesday through Friday, the metal would be trading at multiples of its current price. Mondays alone have cost silver investors billions of dollars in value over the past 2 decades. Billions. Not through fair competition, not through legitimate market forces, through an algorithm that runs like clockwork in the dead of night. Now, any honest investigation must address the counter-arguments, and there are those who will tell you that everything I have described is perfectly normal, that the Monday dip is nothing more than weekend risk repricing, that traders sell silver on Monday because they are adjusting for uncertainty that accumulated over the weekend. Let us examine that claim. If the Monday dip were simply weekend risk repricing, you would see the same pattern in gold. Gold carries the same weekend risk. Gold is traded on the same exchanges during the same hours by many of the same institutions. Yet gold does not show the same statistically significant Monday decline. If the Monday dip were weekend risk repricing, you would see it in oil, in copper, in soybeans. You do not. If the Monday dip were weekend risk repricing, it would diminish over time as markets become more efficient and traders exploit the pattern. It has not diminished. It has persisted for over 15 years. The weekend risk argument fails every single empirical test you can throw at it. Others will point to the CFTC and claim that if manipulation were occurring, the regulators would catch it. But the CFTC has a documented history of being understaffed, underfunded, and outmatched by the very institutions it is supposed to oversee. Former CFTC Commissioner Bart Chilton spent years publicly advocating for investigation into silver market manipulation before his departure. He spoke openly about the difficulty of pursuing cases against institutions with virtually unlimited legal resources. The fox is not just guarding the hen house. The fox designed the hen house, installed the locks, and hired the security guards. Dismissing this evidence as conspiracy theory is not a rebuttal, it is a deflection. And the people doing the deflecting have a very good reason to keep you from asking questions. So what does all of this mean for you? For the everyday person watching this video, it means that if you own silver, physical silver, silver ETFs, silver mining stocks, you have been systematically robbed. Not in a dramatic headline-grabbing way, not in a way that shows up on your account statement as theft, but slowly, quietly, week by week, Monday by Monday. Every ounce of silver you hold has been artificially devalued by a mechanism designed to benefit a handful of institutions at the expense of everyone else. Your savings, your hedge against inflation, your retirement diversification, all of it suppressed. But here's the part they do not want you to hear. This system only works as long as 2 conditions are met. First, the paper market must remain dominant over the physical market. As long as prices are set by futures contracts that never result in physical delivery, the algorithm can keep doing its job. Second, people must not know. Awareness is the single greatest threat to this scheme, because once enough people understand the pattern, once enough investors recognize that Monday dips are manufactured, not organic, the behavior changes. Investors stop panic selling on Monday mornings. They stop placing stop losses where the algorithm can harvest them. They start buying the dips instead of running from them. And most powerfully, they start demanding physical delivery. They start pulling real silver out of the vaults. They start exposing the gap between how much paper silver exists and how much actual metal backs it up. That gap is the Achilles heel of the entire suppression scheme, and it is wider than most people can possibly imagine. Every system of artificial control has a breaking point, a moment when the forces being suppressed become too powerful to contain. And silver is approaching that moment faster than most people realize. Global silver demand has outstripped supply for 3 consecutive years. Industrial demand, driven by solar energy, electric vehicles, 5G infrastructure, and advanced electronics, is surging at a pace that no one in the industry predicted even 5 years ago. Meanwhile, silver mine output has plateaued. New discoveries are declining. The average grade of silver ore has fallen by nearly 40% over the past 2 decades, meaning it takes more energy, more labor, and more money to extract less silver. The physical market is tightening. Vault inventories at the major exchanges have been steadily declining. The registered silver available for delivery at the COMEX, the primary U.S. futures exchange, has fallen to levels not seen in decades. And the algorithm? It is still running. Still suppressing the price every Monday morning, still pretending that silver is worth what the paper market says it is worth, but you cannot suppress a physical commodity forever when the physical commodity is disappearing. At some point, someone large enough will stand for delivery and discover that the silver they were promised does not exist. At some point, the paper promise and the physical reality will collide. And when that happens, the Monday algorithm will not just fail, it will reverse. Every artificial dollar of suppression, every manufactured Monday decline, every stolen percentage point will come roaring back like a spring that has been compressed for decades and finally released. The question is not if, the question is when. And there is historical precedent for exactly this kind of reckoning. In the late 1970s, the Hunt brothers attempted to corner the silver market by demanding physical delivery. The price surged from $6 to nearly $50 an ounce before the exchanges changed the rules mid-game, allowing only liquidation orders and effectively crushing the rally by decree. They changed the rules because the system was breaking. Today the dynamics are different, but the pressure is the same. Except this time it is not 2 wealthy brothers demanding delivery. It is thousands of individual investors, industrial users, and sovereign nations all simultaneously realizing that the paper market has made promises it cannot keep. The scale of the reckoning, when it comes, will dwarf anything the Hunt brothers ever dreamed of. I want to leave you with something important. This video is not financial advice. I am not telling you to buy silver. I am not telling you to sell silver. I am not telling you to do anything with your money that you have not thoroughly researched and considered for yourself. What I am telling you is this: the market you thought was free is not free. The price you thought was determined by supply and demand is not determined by supply and demand, and the system you were told protects you as an investor was designed from the ground up to protect the institutions sitting on the other side of your trade. The Monday algorithm is real. The evidence is there for anyone willing to look, and the fact that you now know about it makes you more dangerous to this system than any regulator, any politician, or any financial journalist ever could be. Because the one thing an algorithm cannot suppress is awareness. It cannot short sell the truth. It cannot place a naked short position against human understanding. Share this video, talk about it, look at the data yourself. Go pull up a silver chart and look at the Mondays. Really look at them. Let the pattern burn itself into your mind until you can never unsee it. And the next time someone tells you that the silver market is fair, that it is free, that it is efficient, remember what you learned here today. Remember that somewhere in a server room in the quietest hour of the quietest morning of the week, a machine is running. A machine that was built to make sure you never know what silver is truly worth until now. The clock is ticking, the servers are humming, and somewhere right now, an algorithm is being loaded for next Monday morning. But this time, you know it is coming, and that changes everything.